So let's begin with the US forecast. And I've entitled this, "The Pandemic Haunts the Recovery." And you're going to hear this all throughout the day, that what happens with the pandemic is extraordinarily important for what's going to happen with our economy going forward. And that is really one of the most important risk aspects of the forecast. And we start with two historical pictures. The one on the right is a line outside of a soup kitchen during the Great Depression. Just a kind of reminder that the level of unemployment that we see today has been unrivaled since the Great Depression, but this is a very different recession from that in the 1930s, as this was induced or caused by the onset of the pandemic, which brings me to the left picture. And obviously that's baseball and baseball players wearing masks. This is 1918 during the great influenza pandemic. And during that pandemic, many ball players were ill. And so teams were calling up players from the minor leagues. Boston was one of those teams. They called up a promising young pitcher who led them to the World Series, won as a pitcher games 1 and 4. And you all know him as Babe Ruth. At the end of the season, when Boston had won the World Series, they, for reasons still unknown, traded Babe Ruth to the New York Yankees. But the point of showing you this picture is that we don't have a lot of data going back to that influenza pandemic, but we do know that Boston, in their excitement about the World Series, opened up the economy earlier than, for example, St. Louis. And the evidence there suggests that St. Louis had much better public health and economic outcomes. It's only one data point, but it is suggestive. Industrial production dropped thereafter, but it was also a defense cutback at the end of World War I. And so the data was really confounded with many things going on, but you didn't really see a recovery until you got into the 1920s. So all of that kind of reflects on where we are today. So let's just take a look at our main themes. The third quarter is the end of the strict lockdown. Now we have a partial lockdown nationwide. Broken employment relations take time to heal. You're going to hear more about that later. The Fed's new policy, low rates for the foreseeable future. State and local government cuts are on the way. Housing is a bright spot, but we don't believe that it really has much in the way of legs. And the risks to the forecast are the election, the pandemic, and the federal stimulus. Our forecast is for weak growth, especially in the fourth quarter of this year, with no return to trend over the forecast horizon. So let's take a look at some critical assumptions. And any forecast that you hear, ours included, has to make assumptions about the pandemic and about the stimulus package. And these are ours. That the pandemic in 2021 and 2022 has a moderate to low impact on the economy. And the stimulus package from Washington, a stimulus package, is going to happen and will occur in the fourth quarter of 2020. If those are too pessimistic, then obviously our forecast is too pessimistic, though we think there's more risk on the downside that this may be too optimistic. So turning to some numbers, this is recent GDP numbers at a seasonally adjusted annual rate by quarter, so 2018, 2019, and 2020. And you see the 5% drop in the first quarter of 2020 as the recession began in March, and then a big drop of 38+% in the second quarter. The red bar on the right-hand side with the F above it is our forecast for the third quarter, although we know quite a bit about it as we're ending the third quarter today. And so there's a big increase, just over 28% from the second quarter to the third quarter. And that's really a rapid rate of growth. But let's keep in mind that that red block is still significantly below the previous peak. In fact, it's 4.5% below. In the Great Recession, that's the 2008-2009 recession, peak to trough, we lost 4% of GDP. So we're still not out of the woods in spite of that rapid economic growth. And the question is, what comes next? Ed is going to go into a lot more detail on his research as to what determines the shape of what comes next, but I want to show you this to just give you a flavor of that. This is the monthly domestic airline traffic, their revenue passenger miles, one passenger flying 1 mile on a domestic flight in a seat that they paid for. And it goes from 2000 to 2004. And you see it's about 60 billion revenue passenger miles going up into 2001. There was a recession that began, a mild recession in March of 2001. But in September, we had the horrific and tragic attacks of 9/11, and the airline industry shut down for a couple of days. And then it took a couple of months before you had TSA coming up, air marshals, reinforced cockpit doors, and the like. But you see a pattern that looks kind of a lot like the one that I just showed you on GDP. And then it kind of increases gradually as people get more and more confidence that they can fly safely. And that's true today. In the pictures on the left-hand side, the top one is Redondo Beach on Labor Day. So these are folks that have less aversion to risk. And the bottom is a trail, the Chorro Grande Trail, that goes into the Sespe Wilderness, where anyone who wanted to go out and be outside but not encounter other people, a higher risk aversion would be. It's going to take time for those who didn't want to go to Redondo Beach to feel comfortable doing that. And so that means that consumption of those kinds of services is going to grow back slowly. So this is our consumption forecast. You see the downturn and then the upturn in the third quarter, but then it kind of flattens out. These are quarterly averages. And you're going to see later as Ed goes through his research, the monthly data, but it sort of flattens out as people get more and more comfortable with the safety of consuming services. And consumption doesn't get back to its previous peak until the first quarter of 2022. That is going to influence dramatically GDP because consumption is about 70% of GDP. So this is our GDP forecast. Looks pretty much the same. And in the first quarter of 2022, we get back to where we were in 2019 in the fourth quarter, our previous peak. But keep in mind that this is 2 years have passed without economic growth. So if you just look at the blue blocks on the left-hand side and kind of move your eyes along them, they have an upward trend. That was a 2.4% economic growth economy. We don't get back to that in our forecast horizon. So we're still well below potential GDP. Turning now to employment, I want to show you this data on weekly initial claims. So this is when someone has a payroll job and they're laid off and then they apply for unemployment insurance, they show up in these numbers. And this is the last 8 weeks. In August, it was up around 1 million. Then it drops to just under 900,000. But if you look at the last 4, they're not coming down very fast. So we still have very much elevated initial claims for unemployment insurance. And this is more than 200,000 people per week than at the peak of the Great Recession. So if this trend were to continue, we'd be well into December or even January before we got down to the peak of the Great Recession. We think it's going to come down faster than that, but this is something to keep an eye on because it illustrates that labor markets may be a long way from being healed, and this is a risk that we have to our forecast. But that leads to our forecast for non-farm payroll employment, and it has the same shape as GDP. That block in the middle, which is half orange and half blue, is because we have 2 of the 3 months. These are quarterly averages. 2 of the 3 months are actual data. But the forecast looks pretty much the same, except for we get back to the previous peak, not in the beginning of 2022, but at the end of 2022. And that's because the sectors that are hit the hardest in this recession are sectors of human touch or human contact. And those are the ones that are going to come back the slowest, but also those are low income sectors. So the high income sectors are going to be growing faster than the low-income sectors. This is something we'll talk about a little later during the keynotes, but it means that the inequality that was growing in the last expansion, absent policy interventions, is going to continue to grow. The flip side of this is unemployment, and the unemployment rate comes down, but it's still above 7% in 2021, and it doesn't go below 6% until we get to 2022. So elevated unemployment rates, and of course we've had growth in the labor force, even though we get back to the same number of jobs that we had in the fourth quarter of 2019, we don't get back to the same unemployment rate. Moving on to financial markets. Some people say the stock market's not the economy. Actually, it's not the current economy. It's a forward-looking view of the value of companies. And as you can see the pattern here, 2019 going into 2020, the steep drop and then a fairly rapid response. And a good part of that is technology. Tech companies have been doing fairly well, and the market reflects that. But interestingly, as you go to the right, it looks very much like the same kind of broken V, where that upstroke of the V is broken and flattens out, that we see in the real economy. The Fed is committed to providing ample liquidity in the economy, and some of that liquidity is finding its way into the stock market. But the Fed's balance sheet is up to $7 trillion, and the Fed has rolled out a new interest rate policy. This is Chairman Powell explaining the new policy. The basic story is that the Fed is going to stop looking at inflation. Inflation rates have been running at or below 2%, and the policy is, unless they're above 2% for a significant amount of time, the Fed is only going to be looking at unemployment, and not the headline unemployment numbers, but also the components of unemployment, and won't be moving interest rates until such time as that unemployment is, in some sense, satisfactory. And that means that we have a forecast of near zero interest rates going forward. But as our colleague David Schulman says, it's not a vaccine nor a cure for COVID-19. But that means that interest rates throughout the spectrum stay low. Bond yields are at record lows. Here's the 10-year Treasury. That should result in favorable lending conditions for business and for consumers. But the Federal Reserve publishes this survey that you see here on bank lending standards, and the peaks are all with recessions. And if you move your eyes over to the right-hand side, what you see is lending standards for commercial and industrial loans have increased. So that's a mitigating factor that influences business investment. And as a consequence of that, what we have with business investment as it is recovering to its trend growth rate, but it is not going to be a real driver of the economy. On the other side of this are households, and existing home sales have soared. They're now above pre-recession peaks. And this is because of low interest rates. It's also because of folks trying to move to larger homes with work at home. So there are a number of factors that are affecting this. And these factors are near-term factors, which when we put them into the forecast, we think this doesn't have a lot of legs. We're expecting pretty decent home building. This is housing starts. The forecast is in the red. You see it's about 1.3 million per year, and that's higher than pre-recession, but it's not growing. It's a pretty stable at 1.3 million a year. So again, it's not going to be an engine of superior economic growth going forward. That brings us to government, which is in that other 30% of GDP. On the federal government side, deficits remain above $1 trillion per year, and therefore goods and services were only going to grow modestly. Transfers, which are the stimulus packages, they're going to end and they're going to decline sharply. And state and local governments are now in the new fiscal year and are in the process of contracting due to short revenues. So in summary, fear of crowds and broken employment relations dampen consumption demand. State and local layoffs are on the way, and uncertainty is restraining real investment. The Fed's new policy, low rates for the foreseeable future, which leaves housing as a bright spot in the near term, but not in the longer term. And government is pulling back, so fiscal policy is limited. So all of this tells us that we're going to have slow growth, and there's heightened risk, particularly in 2020 Q4, where we have a growth rate of 1.2% in GDP, and that's not far away from zero. So let me conclude with a reminder that the pandemic in 2021 and 2022 has a moderate to low impact on the economy. The stimulus package from Washington we have in the Q4 of 2020. Again, it's anybody's guess if that actually is going to occur. And finally, mask fashions are all the rage in 2020. Here are my three. The one on the left has mathematical functions on it. Then Vincent van Gogh's Starry, Starry Night, and you can take whatever you want from the one on the right. So thank you. That concludes a brief summary of the national forecast. And now let me turn it over to Professor Lemur to talk about some of the details of the shape of a recovery.